This interview is brought to you by First Majestic Silver Corp., one of the world's purest and fastest growing silver mining companies.
Okay, ladies and gentlemen, we will go ahead and get started straight away. My name is Chris Berry. I'm your moderator for the World Economic or World Outlook panel over the next 30 minutes. Now we're running a little behind schedule, so we'll cut right to it. Again, for those of you that don't know, the panelists to my right, we'll just do a very brief introduction. Of course, Ned Goodman, President and CEO of Dundee Capital Markets and Dundee Corp. Obviously, the resumes of these individuals goes for much longer, but in the interest of time, we'll just continue on to his right, Mr. Frank Holmes, CEO and CIO of U.S. Global Investors, and then rounding the bend down there is Danielle Park. This is a CFA, and she's the President and Portfolio Manager of Venable Park Investment Counsel. So I guess to start off, one of the looming the biggest sort of looming economic issue that I see is the fact that next week the Federal Open Market Committee is planning on meeting, and the long-awaited announcement on the potential to taper asset purchases is supposed to be announced. So, Ned, I'd like to start off with you. Can you give us your thoughts on the taper? Will it happen? What will it look like? And what are some of the potential consequences?
I don't think I'm going to live long enough to see a taper. And I intend to live a long time.
Okay, Frank?
I don't think the tapering is going to be as what a lot of people are expecting to be. I think it's going to be very gradual, because every time they've done something with a blunt hammer, it's had massive negative ramifications. And you can just see what's taken place with mortgage rates rising by 30%. Immediately you see Wells Fargo lay off 2,300 people, JP Morgan laying off in the mortgage business, and those are in tract home business, in particular people like Warren Buffett, who's very big in tract homes, those sort of modular houses, cost you $120,000, they put them up right away.
And those are companies that are protected by the Federal Reserve.
They are.
They're a member of the Federal Reserve cartel.
They are. And it's interesting enough, I was just speaking with some bankers this week, and they said that people no longer qualify. And that short interest rate where they put down the $10,000 to be able to get this house and put on the lot, in this past couple of months, they no longer qualify. So I don't think that you're going to see this dramatic raise of interest rates basically peak here.
Okay, Danielle.
I think they're going to start to taper, but I think that they will no doubt be horror shocked at the downward vector of the economy over the next few months. They have been surprised at how slow and tepid the recovery has been to date, and I think that they are also going to be taken unawares, at least so they say. I mean, I don't know if they're actually obtuse or if they just wax obtuse because they need to, but I think that they will probably start to taper because their party line so far is things are getting better. And, you know, they've been effective in stimulating the economy according to them. So they'll probably go ahead and start. But I think that they'll be shocked at how bad the economy begins to do, and most importantly, the stock market and possibly the bond market will sell off further. And I think those two things may yank them back to the next bright idea on monetary policy.
Okay. Well, continuing with that, and Frank, we'll start with you and just come around. You've obviously done a lot of work with emerging markets, and in particular China. And I think one of the consequences of when Chairman Bernanke came out in June and at least suggested tapering, it sent emerging market equity indices, and in particular the currencies, into a tailspin. And so he sort of had to jawbone the market back. Is tapering, or the threat of tapering, a real threat to emerging market growth?
I think that creates great currency problems, especially those with current account deficits. But it's amazing to me, you can find so many incredible small cap companies where families own 15% of the company. They're growing at 10, 15%, 20% returns on their capital, and dividends of 6%. There's just hundreds and hundreds of them in emerging markets. So I don't see the world coming to an end, but I do see what happens when their currencies unravel against the dollar. That just means their ability to export improves. And I think that that's a key factor. And I think when you look back at this last quarter of the S&P 500, the banks made earnings were up 33%. The overall S&P was up like 3%. Had you backed out the bank's earnings, then the S&P actually didn't make any money. So I think it's just creating a tremendous currency turmoil, and I think the key thing to look at in these emerging countries is to take a look at their infrastructure projects and spending, and I don't see a huge curtailment in these countries.
But the bank's earnings came from tapering.
The bank's earnings came from tapering. It came from that
from lack of tapering.
Lack of tapering. I mean,
you keep printing money and you put it into the banks. They make money on it. They charge more for their mortgages, and they're solidly financed.
What I would like to share with you, just for simplicity, is that in this recent raise in interest rates in the U.S., 10-year mortgage, 10-year bonds go from 1.76% to 3%. However, money market funds moved up 1 basis point. So that means the banks are making much more money.
Money market funds are not a member of the cartel.
Correct. And
Cartel
so what they pay
is the Federal Reserve.
But what they pay you for the cash is next to nothing, and what they turn around and lend out, so their spread is greater than ever, and that's all the banks are getting repaired. And so that's what the cartel, I think Ned is trying to suggest, is that a lot of the policies favor rebuilding the bank's balance sheets and income statements. So I think that you have to, for myself, is say that's one factor over here, but just remember that in 1972, China and India had a global footprint economically of 2% of the global GDP. 2%. In 1972, in 1992, China was only 2% of the world's GDP. Today, they're 20%. So it's important to put that there's factors that have changed in that consideration for your question on emerging markets. So I remain very bullish on the growth and the opportunities of these emerging countries.
Okay. Danielle, any comments on that, growth in emerging markets or tapering and the threats?
Yeah, I think growth in emerging markets has been the most misabused and misunderstood concept on an investment basis for the past few years. I mean, if you look at great leverage giveth and great leverage taketh away. So the countries that enjoyed the greatest insurgence of hot money off the infusions that were given from central banks from 09 to 11, for example, they saw a huge ramp in their stock markets, as an example, and their currencies. Canada was along for the ride for a period into 2011. If you look at the statistics, the greatest number of millionaires created between 2009 and 11 were in those emerging market sectors. So it's quite simple. Great leverage came rushing in, hot money flooding the system, and then since then, and when tapering becomes an idea, you see that same hot money flooding out. So I think it's obvious that from an investment basis, they have been hurt and will probably continue to be hurt while we go through this next risk aversion phase.
What's the definition of hot money?
Hot money's excess liquidity flooding around the system doing nothing productive except pooling in certain asset markets.
Does it hurt when you spend it? Is that any different than cold money?
No, but I'm just saying excess leverage creates bubbles in those economies that burst.
Bubbles are not hot money. Hot money, you're saying, is coming into the country. Maybe it creates
into their
a bubble.
asset
Maybe
markets.
It creates a bubble,
in
but
the
it's
asset
not
market.
hot money. It's, the United States and the Industrial Revolution in the 1800s got a lot of money from the rest of the world because it was the place to invest.
Okay, but it depends what they do with the capital.
It wasn't hot money, it was picking where you want to invest your money because it's better.
Okay, well, if they'd have been building anything productive with the money, perhaps it would have been beneficial. But if they're building infrastructure that's not needed, or empty cities in China, for example, it's excess inventory, it's excess capacity, and it doesn't actually help the economy get traction. It may do eventually down the road, but it's not, it's there on an investment thesis, it's not there on a sustainable business model.
There are no really empty cities in China. There are houses waiting for people to move to them. There's a completely different process that they have in China than we have here. Mr. Chanos is a short seller, and he tells every BS story he can to get them his short right, so don't listen to him.
We're going to come back to that, Ned. We're going to come back. I want to push forward with something here, and I'd like to start with you, Ned, and then we'll go back down the line. In your remarks previously, you talked about for lack of a better phrase, the dethroning of the U.S. dollar as the global reserve currency. I'm interested in your thoughts on what's going to fill the void. Is it another paper currency? Is it a basket? I mean, what are some of the potential outcomes there?
If I really knew the answer, I'd write a book. But I don't really know the answer. My feeling is that the International Monetary Fund is being set up to be the central banker to the world. I think that the special drawing rights is the currency that has been chosen. I think, and this is the same thought that I have, that Michelle Obama is going to run for presidency. I have no proof. But I think that the International Monetary Fund will do exactly what Franklin Delano Roosevelt did in 1934. They will confiscate all the gold that every country of the IMF has, and they'll put them in the in the new central bank, the International Monetary Fund, and they'll back a reserve currency which can only be used from country to country. You and I will not be able to spend money on it. You won't be able to get a haircut with it. Each country will have its own currency, but the reserve currency, so that the world can survive and not worry about hot money, as Danielle put it, will be the currency of the special drawing rights of the International Monetary Fund. Every nation in the world is a member of the International Monetary Fund, and the only problem that the International Monetary Fund's to all that is that the United States has a controlling vote, and I think they're going to lose it.
Okay, Frank, comments?
It's really difficult in my lifetime, to dismantle, because I think the U.S. has over 200 military bases worldwide and has the most elite fighting force in the world. I think that is a key factor in its capacity, besides the economics of what the dollar and it means, etc., is just the sheer size and the magnitude and the reach globally of the U.S. military. But I would like to just compliment on Danielle. Her definition was hot money, and sort of add a perspective to it, is that this word hot money is also where people can borrow, and there's a lot of hedge funds that will borrow inexpensively in a country's currency. And my experiences in the investment world, in the global investment world, has been turned upside down so readily because of what takes place with Japan. And if you go back and take a look at every major currency crisis, is because you could borrow inexpensively from Japan, and then this money would roll into another country because you could higher bond rates, corporate rates, whatever it was, they would roll into that country to make that yield spread difference. And then Japan would turn around and say, we want our money back. And all of a sudden you get this unraveling. And if you go back to 1997, a lot of the hot money that was borrowed that went into Indonesia, Thailand, Philippines was money borrowed from Japan, and Japan wanted their money back. However, the money went into skyscrapers. So the Malaysians couldn't take the Twin Towers and send them back to Japan. Indonesians couldn't turn around and send plantations back to Japan. So there's this massive currency devaluation that took place. That is what could take, that's what we've seen with these hot money. And in 2006, we had a big unraveling in the second half of the year in the commodity prices and emerging markets. And what took place in May of 2006 was the Japanese saying they want their money back. So
Frank,
this hot money.
I've got to take you to task again.
He's my
That's
mentor.
the case. All money is hot money.
No, it's not all money.
If I borrow money from Japan to build a super building in Indonesia, you got to believe that Japan's going to want a mortgage on that building. So therefore, when they want their money back, they'll take the building. Okay, I don't know what you're talking about. I mean, the world doesn't work like that. You don't get money just because your name is Frank Holmes and I'm going to be doing good things and I'm going to make a lot and I'll someday pay you back. That doesn't happen.
It doesn't happen?
People do not lend money on that basis.
And they don't make those investments that way?
They get mortgages.
Not always, Ned. They do counterparty transactions all the time.
That's the counterparty transactions means there's an asset on both sides that covers it.
But the other one can't cover it because they can't move the building. They can't move the building.
They don't have to move the building to sell it.
Let's hear from Danielle.
Dear Chris, moderator, I would just like to make an alternative idea, because I know that there's a lot of talk about countries taking back their money, selling their US dollars or repatriating them because they're sick of the credit issues in the United States. Let me suggest another thing. It's been mentioned about the 47 million on food stamps in the United States, and absolutely, I've been tracking that for years. It's actually plateaued. It's been at this level for quite a while. But the thing that's really, I think, important to understand is that you compare that with China. China has millions and millions of people who live on $6,000 average income a year relative to the US, for example. That would, and I thought you were going to just, so what I'd like to say is I think it's very easy for us over here to compare our lot with emerging market households and think, oh, you know, they're just going to stomp their feet, they're mad, they're going to take their money back. I think what's really been happening is that the demand cycle has ground down in the world. Less money is going in their export dollars. We're spending less in the West. Less is going into emerging market economies. Therefore, they have less money to spend. What do they need to do? They need to sell some of their savings in order to pay their bills, in order to feed their people, who are worse off in many cases than our people here. So it's not, I don't think, just an investment thesis where they decide and they're taking money back. I think it's out of necessity. And that's why I'm much more optimistic that the US dollar will have to be the reserve currency, not because it's great and there's wonderful things going on all over the place there, but on a relative basis. I still think that it has to be the benchmark for a while longer here. And I don't know how you're going to feed them gold. I'm just saying it might be the benchmark that we recouple with, and I'm all for taking leverage out of the system. And we need something to keep people from overinflating the thing. But I'm just saying, I don't think it's all they're against the US dollar and they want to buy gold or something else.
Okay, Danielle, we're going to stay with you and come back this way. You talked about the demand cycle grounding down, and that sort of got me thinking about something where there's been a lot of ink spilled lately, and it's the end or the demise of the commodity supercycle. Can you give us your thoughts on, is that valid, or is it pausing, or is it changing? What do you think?
Well, there's a very conflicting two themes I think are important to distinguish. One is the fact that the population of the world is growing, and perma-bulls on commodities will typically talk about the escalating population and the insatiable demand for commodities as a result. I say it's an investment cycle, and the fact that we had the credit bubble brought forward demand from the future, the next few years, brought it forward and spent it in 07, 08, when everybody was buying on credit. So I believe as an investment cycle, it peaked in 08, and that it is going to be in a disappointing period for some time as we work down overcapacity and as we get wealth built up in the real economy and real households. It's not that there won't be use for commodities or need for it, but not on the scale that people were expecting and extrapolating.
Sure. Frank, your thoughts? Is it over? Is it changing? What are your thoughts?
I think that the super cycle that took place when we take a look at the peak, the first big wave in 2007, you had all engines in Europe and all engines in America, and you had China, and they all sort of, the stars were aligned. And since then, Europe is still taking much longer to repair its balance sheet. And you can see that with trade. There's more trade between China and Europe than there is between America and China. So as Europe's taken greater difficulty of rebounding out, it's had a bigger impact on that demand and the exports out of China. So to get that super cycle where it's all realigned, I think it's when the U.S.'s engine is full throttle, and Europe and China, and I think it'll happen again. And I think the key factor to look for is steel prices, because it has such a catalyst for zinc, iron, met coal, all these factors to correlate highly. And with that, I think that we're going to have these pockets of where commodities are going to be in great demand. But we're going to have to get those three big economic blocks aligned where they have GDP growth rates of 3%, especially Europe and America, and China growing at 6%, then the super cycle realigns itself. Because the supply of commodities is very easily disrupted. And the supply of commodities right now, you're going to see gold. Would you agree, Ned? They're going to slow down the supply of gold from mines? Production is going to start to decrease?
I don't know.
I just listened to, I was here at the Merrill Lynch conference today, and all everyone's doing is cutting their projects.
Because Barrick is doing it doesn't mean everybody has to.
No, but I would say that the majority of them are commenting on that supply of themselves. So from that factor, I think the world will have babies and grow faster, and then you're going to turn around and get that supply meeting. And so therefore, the levels of demand will still be robust.
Can I interject now? Sure. I don't think we're going to have a super cycle. I don't think it's dead. I don't think the old one is dead. What's happened is that mining has become very, very difficult. The people first of all, the big ore bodies, they're all known today. And your only problem is with the big ore bodies is that you got to raise the money to put them into production. So therefore, you've got to worry about the price of the commodity, and some of that's been hurting. And the unknown big ore bodies are usually in countries that are very, very difficult to work in, and it's becoming even more difficult because the countries that used to be easy to work in, once you build a mine, decide that they think they should own it, not you. So if anything is happening, it's not that the demand is not going to be there. The difficulty of bringing a mine or an oil deposit into production is getting harder and harder because it's more and more going to locations which are not very comfortable to be in, and costs have gone up enormously. But let me use the McKinsey. McKinsey wrote a report, it's 210 pages long. It's called Resource Revolution, Meeting the World's Energy, Materials, Food, and Water Needs. They worked on 4 resources: energy, materials in general, food, and water. And I'm just going to read some points. So what they're saying here is that 3 billion middle-class consumers are expected to be in the global economy by 2030. That's not very far away. 80% will rise in steel demand is projected from 2010 to 2030. 147% increase in real commodity prices since the turn of the century. And for the last 150 years, commodity prices have gone down. So we're just talking of them coming up and maybe holding up to a level that they can provide the viability of building another mine. 44 million people will be driven into poverty by rising food prices in the second half of 2010. This is 2011, 2012, and that's according to the World Bank. So we need more food as well. There will be a 100% increase in the average cost to bring a new oil well online over the past decade. And that's true because the new oil wells today require all kinds of fracking and all kinds of stuff like that. And up to $1.1 trillion will be spent annually on resource subsidies. $2.9 trillion of savings in 2030. And 2030 is, what, 15 years away. Will be the resource productivity potential, rising to $3.7 trillion if carbon is priced at $30 per ton. That's not likely to happen, but if it does, the number goes up. 70% of productivity opportunities have an internal rate of return of more than 10% at current prices. That's last year's prices. 90% if adjusted for subsidies, and some countries actually do give subsidies. And at least $1 trillion more investment in the resource system is needed each year to meet future resource demands. So there are 15 opportunities to deliver about 75% of total resource productivity benefits.
So I'm guessing...
It is a 210-page report written at great length by people who know what they're talking about. The country is growing. The middle class of the world is growing. The middle class want toilets like you use and I use. They want houses, they want cars, they want roads, they want all those things, and they're getting them. And these are the emerging markets. But some of them have nasty governments, and some of them don't. But so to me, the cycle of demand for commodities is still with us. It's just very, very difficult and a lot more dangerous from a financial point of view because costs have gone up.
Fair enough. You know, we're just about to run out of time, but I'd be remiss if I didn't ask the panelists about gold. And so I would like to phrase the question this way. If you believe in a nascent economic recovery in the West. And Ned, I'm pretty clear we all know what you think of that. But nevertheless, okay, Danielle, we'll start with you and bring it down. If you believe that there's a nascent economic recovery and economic growth and dollar strength is bad for gold, do you think gold is range-bound, or do you think we'll see higher prices, or?
Well, to be clear, my position is that we're very likely already in the midst of the next global recession, or it will soon be evident in the North American data, is my impression of the way things are unfolding. And I also think that we still have the potential for a credit event, like a 2008 style evaporation of liquidity and panic selling across various asset classes, which, you know, I think is also a risk for things like precious metals. Because of the investment insurgence, because of the ETF, because of the passive, these are not people that necessarily will hold something as it falls, or they're more likely to hold it for a while and then sell it by force if margined or whatever. So I think that there's risks to the downside in all asset classes, including gold, if that type of an environment presents. Maybe gold bullion would decouple, but it's very hard to tell because everything is highly correlated at the moment.
And Frank, I know you've talked about the fear trade and the love trade. Can you give us your thoughts on economic growth and the price of gold going forward?
Well, we're in that cycle, that annual seasonal pattern from the summer to Chinese New Year, that you have rising gold prices. And how high they will go will be factors such as negative real interest rates in any country's currency makes that price of gold go up in that country's currency. And B would be the GDP per capita is the key factor for the love trade. And so if we do have this global recession as you're predicting, that would be a real factor. And you've seen GDP per capita for China and India actually be flat. And that has impacted that sort of excessive increase of which I would call for gold demand, even though in China, when gold corrected here in April, you saw a huge physical demand taking place. So I think that we're in that upcycle historically. Will it go to 2,300, 7,000, all these forecasts? That's not what I'm betting on in the next year.
Sure. Ned?
Me?
Yes, please.
I don't think gold's got anything to do with economic activity. I think it's got to do with security and warm feeling that you can trade things. It's historically, it's biblical. It's been that way for thousands of years. Like Eric, I don't think the United States has the gold that they supposedly have. I don't think the 8,000 tons exists in Fort Knox. They told Germany it would take them 7 years to be able to deliver their gold. There's never been an audit on the gold that the United States has in the country. What do I do with my watch? It's up there, okay. The Chinese are buying gold. They're encouraging their population to buy gold. They have automatic machines that will sell you gold in every bank. The Russians are buying gold. Funny countries are buying gold. The Chinese have a dream that the RMB is going to be a world reserve currency, so they're trying to get it backed. Chinese are the largest producers of gold and the largest buyers of gold. So there's you heard me talk about the IMF, and that would be a solution. But I'll come back to that reserve currency again. It's a phony reserve currency. It should never have been a reserve currency. It became a reserve currency because Henry Kissinger fast-talked some Arabs. And today, I don't believe that the gold that they supposedly have, first of all, if they did have it, it's not enough to properly back the currency. The only thing that backs the currency is their ability to print more. They don't have the wealth that the United States is supposed to have the position that it's in. So the point is that when you get to the stage when you are worried about paper money, the only thing that gets you anywhere is real estate, land, hard assets of any kind that will increase in value as you go by. And the one that has been used for thousands of years is the fact that gold is an acceptable thing. Mr. Buffett said you can put all the gold in 2 Olympic swimming pools. And I say to Warren, yes, and that's good. That makes it very scarce. And the best thing that you can have as collateral is something that's very scarce. And gold's hard to come by. It's very expensive to take out of the ground. It's becoming more expensive to take out of the ground. And unless the price is higher, there's a lot of gold mines that won't operate. But it will still form some part of the global economic scene, which is in a complete disarray right now. So it's impossible to see how. But I'll go back to the fact that the IMF is the chosen vehicle to do it.
Okay, and on that note, we will end the panel. Let's have a round of applause for the panelists, everybody.